The Nasdaq is currently in a bear market. The S&P 500 hit bear market territory in 2022. We've had supply chain issues, inflation at 8%, oil prices are going up. It is a hard market right now to invest in. I truly do believe right now is a great time to be investing in the market, just like if you had invested in the market in 2008, in October, in November, in December. Opportunities galore, and you would have made a lot of money. If you go back to the dot-com crash, for example, investing in the Nasdaq really worked out, but did investing in individual specific stocks work out very well for you after the crash? Maybe not as good. So today we're kind of going over a mistake that I think should be on your radar, and it's on my radar, and I'm trying to actively avoid getting myself into this kind of trap. So hope you stick around. Got a good one today. Let's go ahead and let's get started. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. All right, everyone, let's go ahead and get started. And do want to remind you real quick, down in the description below, there are some affiliate links. If you want to support the channel, definitely appreciate it. And there is specifically a link to Barron's newspaper. So if you're interested in the market, take a look down there if you're interested. And hit that like button, subscribe as well. So let's take a look at this chart. Now, this was tweeted out by Anastasia Amoroso. That's where I found it, and it's from iCapital. Basically, what this is showing us is forward PE and subsequent 1-year and 5-year annualized returns going back to 1990. That's a mouthful, so I'll deconstruct this for you real quick. So basically, what this is saying is the forward price to earnings ratio of the S&P 500 is taking that, and it's saying, depending on how much the forward PE was at which time, what was your rate of return? What was your rate of return over 1 year? What was your rate of return after 5 years? You can see there's definitely a range here. So a 22 to a 25 forward PE, so a more expensive stock market, actually has a lower return, which makes sense. And if you go all the way to a cheaper stock market, a 10 to 13 forward PE gives you a return of 19.2 to 15.3%. 19.2 being the return for a 1-year period, 15.3 being the return for a 5-year period. So dark blue 1 year, lighter is 5-year. And so what's interesting about this to me is that we can take a look at where we are right now. And so what I'm looking at here is the S&P 500 forward 12-month PE ratio. Now this only goes back 20 years and it's a little dated. This is the best I could find for you, sorry, but it goes back to 2019. And so what I overlaid is basically what I just showed you. So over here, I eyeballed this. It's not perfect, but this is 22 to a 25 forward PE. This is the return in this area, right? So if you had invested back in 2018, in the year 2000, at this time, you should have expected over the past year and over the past 5 years to have a negative return given the historical price returns. Looking back today. Now this is this area, so 19 to 22. This is a 8.5 1 year and a 1.85 year. As we go lower, the returns go up basically. That's what we need to look at. So what we're looking at here is right now the forward PE ratio is about 19. And so basically what this chart is telling us is that we're sitting at a 19 forward price to earnings ratio. We could expect about a 1-year return of 8.5% and only an annualized 5-year return of 1.8%. Which kind of makes me think, okay, if I'm investing in indexes, if I'm investing in the S&P 500 as an index investor, well, historically, it's not been a great time to invest based on price to earnings ratio. Being a bit further down is better, right? So a forward PE ratio being down in the 13 to 16 yielded a much better return over that time period. Now, past performance is not indicative of future returns. You got to remember that part. So what happened in the past may not, of course, happen in the future, but it's just interesting to see. But what's interesting, though, is that the higher the market was, the less likely you were to end up making money over this time period, 5 years being the max. Now, if you go further out, I'm sure that the returns are higher. And because as you go out further, the returns are going to end up probably being better, it's going to actually look pretty good if you dollar cost average no matter what happens. So if you dollar cost average on the way down from, let's say, 22 forward PEs all the way down to the 10 forward PE, you just kept buying all the way down, all the way down, all the way down, you're going to average out having a good probable return, at least if you had done this back in the past. And so I'm trying to get across here is no matter where we are with the forward PE ratio of the stock market or the current 12-month trailing PE ratio of the stock market or what's going on, whatever's going on, dollar cost averaging into an index is going to probably always work in your favor long term. You're going to buy these stocks as they go down, and you're going to have an average sitting here in the middle, and the middle is a good place to have an average, making 12.8% in a year, 8.5% over 5 years. And of course, as you get lower and lower, if you bought down, going down further and further and further, you would average out to a lower price. And of course, that lower price would end up being a higher rate of return over time. So let's take a look at this chart tweeted out by Ryan Dietrich. And basically what he's showing you is that the 5 previous worst starts to a year all bounced. And by the way, if you're not familiar, we are actually in one of the worst starts to a year on record. And so what this is doing is it's saying after 100 days, what happens to the S&P 500 index over that time period? So in 1932, after 100 days of that year, the market was down 38%, but the rest of the year ended up being up 37%. Now don't get tricked by this. Going down 38% and then up 37% doesn't mean you're back to even. When you actually do the math, you'll see you've still lost money. But basically the deal is, buying here, you're going to be up. The same with 1939, you were up. 1940, you were up. 1962, you were up. 1970, you were up. And we'll see what happens in 2022. We're down 16.5% when he made this. And so the average amount that people were up after this time period, so after the 100 days is over that we're currently in, is 19%. The median's 15%. So if you want to feel positive about something, think about that. Maybe you've lost a bit of money right now in the market. You haven't realized it yet because you haven't sold, but buying back in that new money that you put in, maybe by the end of the year, you're going to achieve one of these good returns. Past performance is not indicative of future returns, of course, so we have no idea if you'll lose more money, but at least this is just a good way of thinking about how index investing ends up kind of working in different ways. But I do want to make sure that you understand, this is index investing. This is not investing in a individual stock. And so here what we're looking at is Microsoft stock. So this is what would have happened if you had bought Microsoft for $10,000 back in 1999 when the dot-com was happening. And then it ran up from $10,000 all the way up until $16,000. Then it goes down to $6,000. First off, can you hold through that period? Because most people can't do that. And then after that, for the next how many years, it barely made any money. Remember, this is investing $10,000 into the stock back in 1999. It doesn't break out of this until around, let's say, 2013. And that's the time when finally Microsoft went up and never came back, basically. So you would have had to wait from 1999 to 2013. That is a long, long time to not have made any money. How many people are actually going to hold out for that amount of time? But okay, that's just investing a lump sum. What if you invest every single year? So now going back from the same time period of 1999, you're now investing $10,000 every year. So your dollar cost averaging in, instead of making it until like 2013 until you really break even, it ends up happening in 2003, right? So basically, by dollar cost averaging into an individual stock, in this example, it actually does work out. However, there is a problem because this is Microsoft, right? This is not a company that ended up going nowhere, right? Microsoft ended up being an amazing company. It was an amazing company back then. It still is today. But let's take a company that's probably not so amazing anymore. So here's what it looked like if you had invested in Blackberry back then. So in Blackberry, you had invested $10,000, boom, $29,000 by the end of the year in dot-com bubble. OMG, that is very nice, right? But look what happens. It goes down 2003. Let's say you hold through this whole thing. You keep holding it. It goes up to $180,000 by 2008. That's Blackberry. Think of Blackberry today. 2008, Blackberry was an amazing company. And then suddenly, boom. What is it worth today? What is your $10,000 worth today that you added into 1999? It's worth $7,431. So okay, let's say you dollar cost average into this. In this one, I'm adding $1,000 every year to my $10,000, right? So I start with $10,000. Does it look any better? I mean, it doesn't really look that much better. It peaks at $328,000 instead of around what was it, $180,000 before, but look at it today. It's worth $24,000, from $10,000 to $24,000 over that amount of time. You know what that rate of return is? It's 4.2%. That's the rate of return, 4.2%. That's it. Add an inflation in there, you're almost break even. So dollar cost averaging into this stock over a long-term period of time did not end up really working out that well for you. Now, you could say, well, look at what happened here. If you had sold it there, of course you're rich. Well, you could have, but again, you would have had to get there. You'd had to have like multiple years where you didn't make any money on the stock, and you were still adding money into it every single year, and you still were break even at 2003, from 1999 to 2003. And so what I'm wondering, and I don't know the answer to this, but I'm wondering, stocks like Peloton, for example, that got up here, and some people who are watching this video, I know you probably unfortunately bought a stock like Peloton when it was in an area like this, and then suddenly it comes down to here, well, you never recover. Let's change this. Let's go to 2008 and see how your money looks. Or 2007. Let's say you invested in, let's say the very first day of 2007. Let's see how that looks. Invested in Blackberry essentially on the very first day of 2007, $10,000. You had $1,000 every single year to this stock. How much do you have by today? You have $10,000. And along that time, you put $15,000-ish into this stock. So you started with 10. You put 15 in, and it's worth 10. So what I basically wanted to get across in this video is that some of these growth stocks that some people are going to be investing in for the long term because they have big beliefs about them, and whatever that belief is, maybe it's the story that's behind the company, maybe it's the potential that they think it has from maybe people who are pumping it, I don't know, but some of these stocks that were really hyped up, that people have lost a lot of money on, that people are still trying to hold out for, and now they're going back into some of these stocks to try to get them back up, to try to ride up that wave again. Well, this is what can potentially happen. You could keep throwing money into these stocks over the next 15 years, and you could end up having the same amount of money as your very initial investment. So at the end of the day, do you know what you have? Do you have a Microsoft or do you have a Blackberry? It's hard to tell. And so for that reason, what I do is I try to invest in a lot of different things. In my last video, I showed you my strategy right now to add money into the market, how I am investing, and it involves a lot of different things. And in there, I showed you this in my last video. This is how I'm allocating money to the market right now. There's different strategies. One of these uses ETFs to recreate the S&P 500 and overweight the sectors that I like. Some of these are just buying individual stocks. Some of these are doing miscellaneous strategies of things I have conviction on. For example, the energy sector was one of those things I had conviction on, and I added some money, additional money, to an energy sector ETF. This is a rules-based way of finding stocks that I create different portfolios of larger amounts of companies. So at the end of the day, I'm trying to carve out different areas of my portfolio so that if these little individual stock areas don't end up working out, these likely at least will. So anyway, that's all I have for this video. I hope you enjoyed it. Let me know in the comments what you think, and watch another one of my videos coming up on the end screen right now.